So, welcome. Let me make a few introductions. To my far left is Max Newland, who is a partner of mine. He's head of our healthcare real estate group. Max came in early 2013, and one of my sayings as a manager is that I strive to make myself irrelevant, and Max has certainly helped that come. I don't know if it's come true yet, but we're a lot farther along than we were.
I speak for the whole team. We are trying our best to make that happen.
So maybe we're there, but I'm not going anywhere. Anyway, welcome, Max. John Bauder is to my immediate left. He's one of 3 principals of Capstone Collegiate Communities. Together, we've done 15 developments comprising more than $600 million of investment. At this point in time, we've sold 9 of those 15, generating more than $700 million in proceeds. And those sales have produced an average ROI of 2 times and an average IRR of 40%, which is why John's on this panel.
You're welcome.
Thank you. To his left is Peter Westmeyer, who's the CEO and managing principal of MB Real Estate's Medical Office Group. MB is privately held, has been in business since 1982. MB has more than 300 employees and manages more than 23 million square feet nationally in approximately 25 states. Since May 2013, when we did our first transaction with Peter, we've closed, and I said it should be like that debt table in Times Square that keeps changing, because I was looking out front, and it's, I think it had the square footage at 1.9 million and the number of properties at 24. But this week we've closed a couple, so we've closed more than 2 million square feet. That's comprised more than $500 million of total investment, 36 properties. And here's the exciting part for KREP 4. We have 10 additional transactions under agreement that comprise 70 properties and over 4 million square feet and over $1 billion of investment. So it's been an incredible partnership to this point, and we expect that to continue.
By the way, I think we're closing a deal in a few hours as well. So just all your numbers are wrong now.
He's taking over.
To my right is Richard Hutchinson. Richard is the president of Discovery Senior Living. For those of you who were here last year, you may remember that Richard was not, having blown out his knee playing basketball a few weeks before with his son.
Yeah.
So Richard,
Al said I can't play basketball until this one's over.
We're happy he's hung up his high tops, at least temporarily, in the spirit of attending the conference. As Al mentioned, Discovery is our partner on everything that we've invested in the senior housing sector to date, and we've invested quite a bit. Our portfolio is up to 21 assets, and this includes existing assets that we own as well as investments that are under contract. But we're up to 21 assets. That totals about 5,000 units and about $1.1 billion of total transaction costs. And so on a per unit basis or on a total unit basis, that would rank us somewhere between 25 and 30th largest in the industry. And given that our assets are all private pay, Class A assets in strong markets with strong seniors housing demographics, I would say our ranking would be considerably higher based off of just transaction value. So Richard and his team are fantastic. He's not only a great guy, just a solid partner, and we're very happy to have you here.
We're hoping to make those numbers stale soon, too.
I'm getting a missive to say, in the to box, type 90822. So if anybody missed that. There it is. It was a nice segue. Anyway, let's start with Peter. Peter, you've had a lot of partners. In your words, what differentiates our partnership from others that you've had?
Well, first of all, thanks for the intro. It's great to be here. To answer your question, we have had a number of different equity partners, and we've kind of run the gamut of varieties. We've had large private equity, small private equity, state pension fund, sovereign wealth fund, family office type investors. And really the way we used to do it is we would source a deal, put together a package, effectively negotiate all the terms, take it to our partner and say yes or no. You fast forward to today, and we have you guys involved from the front end through due diligence, through negotiation of the contract. We get your legal, asset management, investment, construction teams all incorporated into our process. So it's a totally different
Al, not to cut you off, Peter, but I wanted to add something to that because I know Peter was talking about the experience with the Kane folks on the underwriting and the negotiating and all that other stuff. It actually started for us a little bit earlier than that too, because we had a transaction, if you recall, the conservatory transaction, that Discovery and many other players in the industry, it's a portfolio of over 1,000 units. We coveted it quite a bit and was never able to get that across the finish line. Well, Max, who's been in this industry even before coming to Kane, had a relationship with the folks at Conservatory, and he was able to get that deal on the table for us and again, get it done.
Yeah.
So that's different.
And the problem is our first two deals in the seniors housing space were a $400 million portfolio and a $300 million deal. So I get the comment from Al almost on a daily basis. When is the next $400 million portfolio?
That was
They're
within
kind of
1
tricky
year
to
of
come
Max
by.
joining us, so he's on a portfolio dry spell. But the owner of that portfolio was a 78-year-old woman, so bringing new meaning to senior relationships. Got it done.
Well, relative to, I know closings are very important, as we all know. We want to have a profitable end result. But when Kane was selling the first portfolio, Al and I had a handshake relationship that we were going to add a phase to one of our properties that was in the portfolio. The purchaser of that portfolio decided in the 11th hour, right before we were getting ready to close that third phase, that they didn't want to do the third phase. So I looked at Al and I said, what do we do? We're ready to go, we're ready to close. And he said, John, we're going to honor our commitment to you. And they did honor that commitment. So the partnership is critical when it's a two-way street, when it's not everything you wanted or thought it was going to be. And Al and team did exactly what they said they were going to do.
I would just say, following up on that, we had the only development that we've ever delivered late was a property in Boone, North Carolina that was being built last winter, and due to the horrific weather, we were not able to deliver it on time. And John and his team, Rob Hallen, his partner, came in and said, hey, we're not going to be able to deliver this on time, and there are significant overruns, but that's why we do what we do. And so they completely stepped up. There was never a discussion about,
Let's
us
retrade the
putting
deal.
in capital, let's retrade the deal, let's figure something else out. We didn't anticipate that. So it certainly works both ways.
And just to jump in, what's interesting, just hearing you all speak, and it came up in Rick's speech last night and Bob this morning. The word partnership is being used quite a bit, and I think there's a reason for that. These are true partnerships, and throughout different transactions, we as a partner are always trying to improve things. And so one of the big shifts at Kane Anderson this year that we made is we're now aligned kind of throughout the firm in verticals. So we have dedicated people doing seniors housing, or focused on medical office, focused on student housing. Craig and his team do a great job. We've got Bill Lewidis is dedicated to student housing. Sharif Pitts is dedicated to interacting on the seniors space, and Antonio Minchella talks to Peter and his team like 20 times a day. And the reason we do that,
I mean, interrupt. I went to Peter's office a couple weeks ago, and there's a calendar up there, and then there's a cutout like this one of Bob of Antonio looking over the calendar. So I sent him a shot of it. He said, "Good, they know I'm watching them."
Yeah, well, I mean, even better. This morning at
Up there at
breakfast,
one point. Yeah.
this morning at breakfast, Antonio and Krista, who works very closely on MB's team, literally had their computer open and they're reviewing a closing statement together.
Yeah, we were doing that at like 10 o'clock last night, too.
At 10 o'clock last night. So, the point of all this.
It's unique, frankly. And like I said before, I've partnered with a number of different private equity groups, and there was no one that was dedicated to the sector, or no one that you could call and knew the sector. You bring up a certificate of need to somebody from a different private equity group. something granular like that, and they have to go and research it, where I call Antonio, I call you guys, you're versed in
Absolutely,
it. You know it.
absolutely.
And Peter, to your point, we worked between the three of us the longest with Kane, and initially my team was going, oh my God, these guys are all over everything. You know, they're in marketing, they're in management, they're in construction, but what is the result of that is now my team is excited to have them because it creates a collaborative effort, and the end result is we get a better product, we get new ideas brought to the table, so it's turned out to be terrific.
But I think that, I'm sorry, go ahead, Richard.
Yeah, I was just going to kind of dovetail into that, John. You know, because a lot of it sounded a little bit negative, like it was an intrusive process. It's not an intrusive process. It's very much that partnership word that Max had said, and there's a ton of benefits to doing it. Because now when I'm speaking to Sharif or Max or anybody else on the team that's dedicated to seniors housing, I can speak shorthand. Mm-hmm. You know, it doesn't take as long to communicate my message. Right. And that, I mean, from an efficiency standpoint, it's a great thing.
But I think what I said in my talk about differences of opinion being welcomed and almost required works with each of these partners, because you guys and your teams are willing to check the ego at the door. And so the reality is we're looking together for the right answer, not a predetermined answer with a rationale to support it. And I think that it's because of the integrity and because you know that about us, we're never looking for a leverage point. We're never looking for, well, how do we, it's us together. We're looking to say, is this the right thing to do? And let's challenge our assumptions, because as we know, these sectors, all of them, are changing quickly every day. So it's a looking forward dynamic.
Agreed. I mean, we encourage debate, and we also have one thing I skipped over. We have dedicated on the accounting side on Sean's team. We have people that are focused now on the sectors, and it's all to encourage debate, encourage people to specialize, know what to look for, and we start the dialogue that much sooner in the process.
I know for us in seniors housing, and I'm sure it's the same for you guys, you try to differentiate yourself a fair amount, and I can tell you the resources that Kane brings to bear, it's not only just the day-to-day blocking and tackling, but it's the ability to think outside that box. Al says check the ego at the door, and in Discovery we have this, don't drink your own Kool-Aid type of mentality, and so we're always looking to stay on that cutting edge. What is next? And with Kane and the partners they have, we're able to look across the business line and across the sectors. So something that may be working in student housing may have may be able to be applied to seniors housing. We're happy to look at that and see if that works for us. Sometimes it doesn't, sometimes it does, but either way, at least it brings that mentality that, hey, be open to change and be open to have a future type of focus, and that's what we do.
And the resources, you mentioned the resources that they bring. Obviously, they're insightful, knowledgeable, and they bring resources like debt financing capabilities that we didn't maybe have as good as they could bring to the table. And insurance, we've talked about insurance
absolutely.
In the past, and we manage 23 million square feet, and we have a lot of buying power with insurers, but Kane they went through a process, I think Frank led the process, brought in Lockton out of Denver, and they pushed our insurance costs down tremendously, 30, 40% in some cases, which is great. It goes straight to the bottom line in some properties.
And that happens across the board.
And I think that happens on the financing side. The scale and aggregation and the capital capabilities happen both on the financing side and also on the exit side, as we saw with the student housing portfolio in 2012. And we anticipate executing exactly that same strategy in medical office and senior housing as well.
Yeah, I know for us in seniors housing, certainly our ability to scale and the benefits on that from an investment standpoint is magnified greatly with Kane, and we truly appreciate the ability to do that. Just circling back just for 1 second, it's funny because Peter and I will have dinner once in a while together, and we'll talk about our experience with Kane, and it's always, well...
It's always positive, by the way.
Okay. And it is always positive, but we're always focused on, okay, well, what do you know, what do I know, and then what does Kane bring to the table, and how can we help each other? So it's not only the Kane resources now, it's opened up for discovery. You know, I can speak to John, I can speak to Peter, and just bounce things off them, and it's a great partnership because of that.
You know, I think Piedmont, I mean, just to take a specific transaction, Piedmont, which was focused, which was one of the 5 properties that we showed in that medical office video, was the first transaction that we did with Peter and his group, and it's indicative of sort of a true partnership and what the partners brought to the table, because we, Kane, had a very close relationship with the seller of that property, which was Carter USA, and Carter literally spent 18 years getting that property developed. It was a land assemblage that started in 1996, and so
The stars aligned on that transaction because you knew the seller, you had experience with
Wait, I
them.
wasn't done.
The stars aligned. You knew the seller. And Jim spoke on that video as well. We knew the tenant. We'd purchased 3 properties with Piedmont Healthcare as a tenant, so we could get insight into their intentions in that building. But also, we bought a plot of land that has the ability to build 150,000 square feet. So we had the ability to get insight into their future intentions at that site, which really allowed us.
Well, let me boil it down. I mean, Carter was willing to take a lower price from us than from anybody else because we were able to structure a venture in which the adjacent land, Carter USA would be the developer at some future point in time. We knew that that property would be developed, that not anybody, and nobody else knew that because of Peter's relationship with Piedmont, and Piedmont had told Peter, we're growing so rapidly, we're in 61% of your building today. It was a 91% occupied building when we bought it. We're probably going to need the rest of that building in very short order, and within 5 years, we're going to want to build the suite adjacent to the property that you're buying. And now this is now 18 months later, they've actually said within the next 18 months they'll need to build the suite. So what that means for us is we underwrote a 91% occupied building with 15-year leases to credit tenants. It's now 100% leased and shortly to be 100% occupied. And within 18 months, there will be an adjacent building that's a build-to-suit for Piedmont. It's a AA minus tenant, and we hold that land at a 0 cost basis. And
Great
that
story.
transaction would not have been able to have been done without both sides of the equation.
What's also cool about that transaction, and you mentioned this, that was our first transaction with Peter's team on the medical office space, and the collaboration that these guys are talking about, I think, really molded how that partnership would work for the remainder of its term, and we're now collaborating earlier on in the process, and I think the results are that much better, and really, I mean, in many respects, the Aston Gardens transaction is very similar, where we had GE involved. You know, all parties are working together very early on, and I mean, GE is a big part of our business going forward. It's a pretty neat thing.
They were the lender on the Piedmont property.
Yeah, I mean, we had some bumps in the road at the end of that. You know,
In the Aston deal.
Yeah, so I always say, like, when you're on the 1-yard line, you're on the 50-yard line, which I shouldn't say after the last Super Bowl. But
And by the way,
Patriots fan,
yeah,
so okay.
massive Patriots fan.
Thank you, Al.
But why don't you talk to that, Richard?
Sure.
I mean,
So I know on that first transaction we did together, you know, your first transaction, you're kind of feeling each other out and exactly where it is, and everybody in the transaction, as happened in most transactions, felt they had given enough to get the deal done, and there was still a small gap. And at the end of the day, we just all met up, and in our first deal together, Kane stepped up, funded the majority of that gap to get the deal done across the goal line. And, you know, that was how we started our partnership. And from there, I mean, we've had that same mentality.
In the first transaction that we did together, that was Dave and I's, you know, 6th or 7th transaction we'd done together. So I think there was an accelerated comfort level because Dave Selznick and I had already done a handful of transactions. So that trust was already there from my side at least.
Exactly.
Hopefully yours.
You're sitting here. So why don't we open it up to questions? We have some that have already come in. One question is, what is the mix of student, medical, and senior housing in each of the portfolios, which I'll address going backwards. So Fund 4 which is the fund that we're about to complete raising dollars for. We anticipate the mix being about 40% medical office, 40% senior housing, and plus or minus 15% student housing. And I think not just me, I think John would agree, and this is one of the reasons that we love partnering with John, is that there is an opportunity in student housing today, but it's not the same opportunity that was there 5 years ago. And we anticipate that there will be, a very significant opportunity at some point in the future, that point being when there is a major dislocation and liquidity dries up, which for those of you who are old, I say I've been around, for 1988, 1998, 2008. There's some symmetry to 2018, not a prediction, but we know the hammer is going to drop at some point in time, and at that point in time, we will be poised and ready. But one of the things I love about working with Capstone and with John is that unlike most developers, I think you have one development in process.
Right, and
So
last
versus,
year,
yeah.
to your point, last year we delivered 7 deals. I think the amount was about $480 million. This year we have 1 development under construction. The challenges in the marketplace, some of the markets are overbuilt, and we're not going to go into those market types. So we're being very selective going into the markets in the future.
Yeah, and I'd say, going back 6 years ago, we were targeting, and many of you know this, 75 to 80 student housing markets. Today, our focus is 25 student housing markets. And so, we've seen the supply-demand gap narrow dramatically, and consequently, we've adjusted what we do. But finishing the first question, Fund 3 was roughly the same as what I just said for Fund 4. It'll actually end up about 40% each, medical and senior, and roughly 20% student. Fund 2, I think most of you know, Fund 2 has 36 properties. 18 of those are student housing. That's the vast majority of the value in Fund 2 is the 18 student housing properties. In addition to Piedmont, which is the only medical office property in Fund 2, and there are 2 conventional deals in Fund 2. The other 15 properties are self-storage properties, which most of you don't know because we haven't sent anything out on this, but our self-storage portfolio, which is 11 properties from Fund 1 and 15 from Fund 2, are under contract, and we expect that to close by the end of March. And Fund 1, for those of you who go back to the beginning with us, at this point in time, Fund 1 is 11 self-storage properties, which accounts for approximately 70% of the remaining value in Fund 1. 4 student housing properties and 2 conventional properties. So let's talk about, let's follow on, what we've seen in student. We talk about CON and and the supply-demand imbalance in medical office today. I know a lot of you in the audience have seen articles. There was one in the Wall Street Journal last week, medical office. And so when you start seeing those articles, I know that, on the one hand, hopefully you see us as prescient. On the other hand, it leads to some trepidation because, once Wall Street Journal articles start appearing, you're talking about more competition. But let's talk about it.
The overbuilding, the supply-demand equilibrium in medical office is such a compelling component of that, of the sector. There are no speculative medical office buildings. There are very little speculative medical office buildings. When there's a need, there's a new building going up. So they're largely build-to-suit, and that's the only type of transactions we do is if we're doing development, we do build-to-suit.
There are a couple reasons for that. One is 36 of 50 states have a certificate of need requirement, so you can't just have a zoned entitled piece of land and say, hey, I want to build a medical office property. The other reason is, and this may be true for the other sectors with lenders as well, but at least they recognize it here, they don't understand medical office. So you cannot get a spec loan for a medical office building. Unless you walk in with a 70 or 80% tenant minimum for your building, you're not going to get a medical office property built. And so I think from an overbuilding perspective, we're looking at a supply-demand disequilibrium for at least the next 5 years, if not
The
longer.
supply's not keeping up with the demand. It's a generally accepted thought.
And why don't you address that for senior housing, Richard, as well?
Yeah, for the seniors housing space, as most of you know, there was 0 new inventory added during the downturn. So there was a fair amount of demand backed up in this space, and some of that's flushing through now, and there's some deliveries of a lot of assisted living in various locations. You have to be smart about where you build, of course, but seniors housing, and especially the space we occupy in seniors housing, which is mostly independent living. I know we have some lenders to seniors housing here, our lender partners, and they could back up this statement. There's been very little independent living built over the last 6, 7, 8 years. And our focus now has turned, we do have some assisted living projects that Max had, spoke about earlier, but we've moved on to independent living, and there's a plethora of opportunity right now. A lot of underserved markets, major metro markets that we're looking at right now. Going forward, you know, I've been doing this 20 years now. Similar to what Al said, I've lived through a few cycles. We will have flybys. There will be people coming into the sector with no experience. Seniors housing in particular, very difficult to be successful if you have zero experience coming in. And so I know Kane recognizes that, obviously Discovery recognizes that, and our lender partner recognizes that. So we're going to continue to do smart things, and as people come in and don't do well, and I hope they all do great, if they don't do well, that's just another opportunity for us.
And one thing to add, I mean, about all three of these sectors is they are still highly specialized. Not everybody in the world has the depth of experience as we do. So in terms of just pure banking relationships, ability to build, I mean, it is limited. Not everybody in the world banks these sectors, and those that do, they really look for groups like these.
I think to put some numbers to, you know, what you just succinctly said, Florida has over 20 million residents now. Two-thirds, a little more than two-thirds of our portfolio is in Florida. That's obviously by design, not by default. Florida has approximately 125,000 people a year turning 75. I think since '08, approximately 15,000 units of independent living have been added. So that's '08 to 2015. So you've got 125,000 people a year turning 75, and you've had virtually no new inventory. Now, Richard knows, you know, all too well how long it takes to, he's in the process right now of building a property in Palm Beach Gardens that I think only took 48 months to get a shovel in the ground.
Thank you, Al. That makes me feel great. I need
Richard
this
had a
water
full
now.
head of hair 5 years ago.
Well, you do have to, from an entitlement standpoint, actually I was having a conversation with someone last night. It is different in seniors housing because at the end of the day, you have your multifamily entitlement process and even some assisted living entitlement process. But when you start into this independent living with services for seniors, a lot of the municipalities just don't have any regulations. They have no process. So you literally go through a negotiation on almost every point for your development. And again, if you're inexperienced, boy, good luck. Good luck.
And then we have another question here on Obamacare, which relates more to Peter's sector than any other sector.
Yeah, how does the healthcare Obamacare impact our strategy? It really doesn't impact our strategy that much. The areas that we're targeting is really relying on the changing healthcare delivery model. There's a move to get off campus out into the communities, and those are the type of medical facilities that we're looking for. It's really approaching a certain patient type and getting out towards them, and that's really where we're most active.
So I think most of you have heard this. I mean, we've got demographics, we've got a dramatically aging population, we've got a changing healthcare delivery model. It's almost a changed healthcare delivery model, where hospitals are acute care facilities only, and really everything else is done off campus, which drives tremendous demand for medical office. I would say the only impact that Obamacare has or will have is that it has expedited that move, which now the train is going 150 miles an hour down the track. So regardless of what happens with Obamacare at this point, this shift is in motion and is not stopping because outpatient facilities provide better care at lower costs. And so that's being pushed by the hospital systems, by the insurance companies, by the doctor groups themselves, and by patients. And so I think we'll continue to see demand drivers because of that.
And in
on a
some
going-forward
communities,
basis.
it might affect the medical office strategy more. It's just those are not communities. We want to go to communities that are private pay communities that these hospital systems are more profitable, whereas if they're all Medicaid or Medicare, they're not as profitable. So we're just not targeting those type of assets or hospital systems.
And just real quickly, I mean, to some extent, on the senior side, I think more people being insured is generally a good thing. People living longer, healthier is a big driver. It's good.
One of the questions here is, are we targeting different rates of return within the different verticals? The answer to that is no. So we're targeting 20+% returns on a gross basis and mid-teens returns on a net basis overall, and we really don't differentiate between vertical in looking at that. Now, there's no black and white. I think we look at portfolio aggregation and we look at different property types, but by and large, across all three verticals, we are focused on Class A plus assets in major markets, and we're targeting those returns. One interesting dynamic, and one of the things that I like about these three verticals, is that in student housing, you turn over approximately 2/3 of your tenant base every year. In senior housing, and many of you may be less familiar with this, you turn over about 25 to 30% of your tenant base every year. And I'm talking about the independent living side of senior living. And in medical office, we turn over probably 8 to 10% of our tenants every year. Now, you have inflation escalators built into their leases, but there's a range of operational intensity and a range of inflation protection also with the three different verticals. But from an overall absolute return perspective, we're looking for the same returns across the board.
The only thing that I would add to that, and a couple of these questions came up last night at the dinner about our pipeline. I mean, we're targeting those returns, and our pipeline today is as good, if not better, than it ever has been. I mean, part of that's because we've now been in the market. We've done a ton of deals. We've got a great reputation, but in terms of deploying capital, I think we're going to do it fairly rapidly as we have in the past, and it'll be predominantly acquisitions versus developments. But we're looking at some very intriguing investment opportunities.
Richard, why don't you grab this question? It says on the senior housing side, why not own assets with a higher level of service, more assisted living, memory care, et cetera? There's clearly a need.
Sure. Well, to clarify, we do. We own assets. We own assisted living. We own memory care. We predominantly own independent living, which just by its very nature are a larger campus, so you have a lot more units on the independent living side. So we actually do have a fair amount of assisted memory care. One of the differentiators for Discovery, and something we've been successful at over our 20 years, and really I think we have a decent reputation in the industry about, is we are sales-centric. And so your sales and marketing process for independent living versus assisted versus memory care, very, very different. And so one of the differentiators for us, as I had said, being sales-centric, we have the metrics and the marketing system, the lead generation ability, and then the ability to sell and close on the independent living side that's different than most folks. And for that, that's a strategic advantage for us. It's a great sector. As I'd mentioned, it's very underbuilt in most markets, so we want to focus on that. But it is important to have a balance of product diversity. So for us, we love to have independent living with some assisted and some memory care on site, and many of our communities have that. That continuum of care is very attractive to the prospects and the residents and their family members, and so we do focus on all three.
I'd say just from our perspective, when we look at the opportunity in the aging population and the demographics, from an independent living perspective, I think our average tenant duration is 39 months, plus or minus. On the assisted living side, that's 12 months, 10 to 12 months. So when we look at the aging population and who we want to serve and where the majority of the demand is going to come, when we look forward, we're looking squarely at independent living as being the primary demand generator, both from the number of people who want to go to that as well as a duration of stay perspective.
I guess the one nuance between independent living and assisted is the whole home health care angle. And I mean, To some extent, the line is blurring to some extent.
Well, we have Discovery at Home, as you well know, Max, and that's a home healthcare company. And so we're able to deliver a fair amount of services, call it assisted living light services, to our independent living residents in their units. And so in a way, we are providing some care through Discovery at Home, which Kane participates in as well.
And we get the duration of stay advantage with student housing is the typical undergrad now stays 5 years, and in your property
Right.
it's 8 years.
Yeah.
Who would ever leave?
And my son is 7 years, so, you know, it's fine.
After watching the video on the senior housing, obviously the lifestyle of a student and a senior is merging. Yeah.
Trying to deliver the
Yeah.
continuum of care.
It's happy hour. Like
As the
Yeah,
kids,
that's
we
right.
take care of you in your middle years, and then we put you in our
We
senior
got it
housing
covered.
property.
We got it covered.
Another question is, what's typical leverage on our assets? This doesn't really differ asset class to asset class. We're roughly 2 to 1 leverage, or 65 to 70%. The one thing I will say is that's typically 65 to 70% loan to cost. So that's day one. We're not generally increasing our leverage as value increases after the fact. And in almost all cases, our properties are increasing in value over time. And so what that means is typically 2 to 3 years into a fund, although we've put, call it 67% leverage on day one, from a value perspective, you find yourself more in the 50 to 55% leverage range from a fund perspective.
Yeah, and just to add to that, I mean, spreads vary very widely, at least in the senior space, based on acuity. I mean, we closed the deal late last year. It was a high 100s, 195, I think, spread, and that can range up to the low 300s. GEs here, obviously, we're hoping that their 300 spread is now in the 200s after this conference.
No pressure.
We gave them sweets, right? So another question, what's the next vertical on the horizon? We don't, I would say, that question's probably more to me than to anybody else. I would say that we've got a fair amount of runway, particularly on the healthcare real estate side at this point in time. So I'm looking at least 3 to 5 years, if not longer, on the senior housing side and medical office. I think in that video I said we're in the early second inning, and I think that is true. Now, I will acknowledge, as pretty much all of you in this room have seen, when we saw an increasing opportunity in healthcare real estate and a decreasing opportunity in student housing, we shifted, and I'd be the first one to tell you that I thought the runway was going to be a bit longer than it was in student housing, but that's fine. I think one of the differentiating factors with us is that we always want to be open to change, and we always want the ability to be nimble. At this point in time, we are not looking at any verticals beyond the 3 sectors and beyond these partnerships and beyond the 3 sectors in which we're involved. And Fund 4 really has become less of a blind pool and more of a dedicated fund, in that we've got approximately 40% of the equity from that fund already allocated to transactions in process, which is a tremendous place to start. There's another question here, and it's geographic diversification, and that differs for each of these sectors.
So we're really guided by, we want to be at flagship institutions. So we're nationwide.
We're nationwide as long as you're SEC, Big Ten, or Pac-12.
Well, that's right.
So the question, are you concentrated on certain states? No, we're concentrated on certain relationships, certain health systems. That's the answer. We'll go where our relationships with health systems that are strong, creditworthy, reliable to pay their rent will take us.
Yeah.
A little different answer for seniors housing. Obviously, right now we have a fair amount of assets in Texas and Florida. It's almost the low-hanging fruit strategy. You have these major markets with large population of seniors who desire our services. There's no sense running up to Oshkosh when we have it right here in our backyard in Florida and Texas. But there's seniors throughout this country, and they all desire these services, and as it makes sense, we'll continue to expand beyond our current borders.
Right. I mean, we haven't. It's not like we've redlined any states or regions, and I mean that I think that's what's really exciting. We are in the second inning of this, and will continue to grow and expand.
Another question, you can address this, John, is the difference between on-campus and off-campus housing, and why is on-campus being priced at lower returns from an investment perspective? So,
Well, the universities have a distinct advantage over us. They can require freshmen to live on campus. They can withhold grades without, if you don't pay your rent. So they have a lot more mechanisms, and they can get money cheaper than we can. So that's why you're seeing the returns off campus as being a bit lower.
no, on-campus.
On campus.
Yeah. No, off-campus is higher, on-campus is lower. Typically, on-campus, it's some kind of leasing arrangement or a 25-year agreement with the university, and so it's essentially a bond. It doesn't really fit for us. You're typically looking at a total return in the 12 to 13% range, with a lot of that return being back-ended. So it doesn't work for an opportunistic fund seeking higher returns, and the hold time frames don't really work well either. And we've seen, and you guys are, not you personally, but your company is involved in the on-campus side. One of the first properties that I did in student housing was in Richmond, Virginia, and it was a public-private partnership. It was with Virginia Commonwealth University, and it was as efficient a process as you're ever going to have with a state school, because you had a very strong school president who basically dictated what the school was going to do. But even going through that process, where the master lease had to get legislative approval from the state, convinced me that on-campus housing was really a political process. So it's a long duration political process, and everything that we've done and endeavored to do has really been entrepreneurial, where we can differentiate ourselves with decision making and capital and inefficiencies. And so since that first one, I've never done anything on campus, and we're not going that direction. I'm sorry.
Yeah.
In regarding medical office buildings, the on versus off campus pricing differential, it used to be very, very wide. On-campus buildings would trade at a 200 basis point premium to off-campus. But kind of in line with the changing healthcare delivery model, there's a bigger desire for these health systems to get off campus. And in line with that, there's been a compression in that differential, where medical office buildings that are on campus will trade from 5 to 6 caps, and off campus are 5.5 to 6.5. So it's really compressed from 200 basis points to really 50, and then sometimes there's not even a...
Well, it's become less and less important how close you are to the hospital. If you're going to have, a melanoma removed, you're not really worried about whether you're a mile from the hospital or 5 miles from the hospital. You're not looking at an acute care issue.
Mm-hmm. Right.
So it's more, really what's happening with medical office and with medical delivery has become a retail system. So you're serving a population base, you want to be in locations that are convenient for people to access.
On-campus will never go away, though. There's so much investment. Hospitals invested billions of dollars on their campus, so there still is a need to be there, but the off-campus has just relatively gotten more attractive.
So we have a question here on the disposition realization strategy on senior housing. So we bought Aston Gardens in September 2013. That was 1,930 units, all Florida, essentially 2 in Fort Lauderdale, 2 in Naples, 1 in Venice, 1 in Tampa. We bought another 1,053 units in Texas, which is a conservatory portfolio that you spoke about earlier. Right now, we actually own 3,423 units, another 1,400 under agreement. Our view would be, so at this point, we've actually got the scale that we'd be looking for a disposition, and we've had tremendous interest. In fact, shortly after closing on Aston Gardens, we were approached by one of the very large publicly traded REITs about acquiring the Aston Gardens portfolio from us at a significantly higher price than we had just paid. At that point in time, we weren't interested, but what we're looking at is an aggregation strategy that we think is incredibly compelling to REITs and sponsor groups, and I think that if we continue on the path that we're on with conservatory, we will have early next year a 97% occupied portfolio between Florida and Texas that has well over $1 billion of value. And we think there would be tremendous interest from the REIT sector as well as multiple sponsor groups and others. And so it's the exact same strategy that we pursued in student housing. The thing I'll say for both medical office and senior housing is that the potential exits are far greater than in student housing because you have so many more players of scale who are looking to acquire in those sectors. And most of the publicly traded REITs own both senior housing and medical office. And so it's not unlikely that there might even be a disposition that would involve both asset classes at some point.
Agreed. And I mean, I've got close friends at all of the big REITs who would be players, and they're just, until a pool of assets gets to a certain size, it's just highly inefficient for them to go after the onesies and twosies, which for these sectors are really the nature of 90% of the transactions that get done.
All right, so the coffee's probably kicked in. We're going to take a break. We'll reconvene at 10:30, and we'll have our final two panels from 10:30 to about noon. Thank you.